There's a monumental, almost imperceptible shift occurring within the highest echelons of global finance, a quiet rotation of capital from the traditional safe haven of gold into a metal that has long been overlooked. And by 2026, this strategic maneuver by big investors will fundamentally redefine the landscape of precious metals. If you're ready to understand the hidden mechanics behind this impending wealth transfer, please like this video, subscribe to the channel for more urgent insights, and comment "Silver Shift" below if you believe institutional money is already positioning for silver's dominance. What I'm about to reveal isn't a speculative theory, it's a meticulously researched analysis of market flows, industrial demand, and the strategic decisions being made by the world's most sophisticated investors, all pointing to silver flipping the script on gold in a way that will catch most retail investors completely off guard. For centuries, gold has held an almost mythical status in the financial world, revered as the ultimate store of value, the bedrock of wealth, and the go-to asset during times of crisis. Its allure is deeply ingrained in human psychology, a legacy passed down through generations of economic turmoil and monetary debasement. But the world is changing at an unprecedented pace, driven by technological innovation, geopolitical realignments, and a fundamental reevaluation of what truly constitutes value in the 21st century. While the masses continue to flock to gold, driven by historical precedent and fear of inflation, the smart money, the institutional investors with access to proprietary data and long-term strategic vision, are quietly, almost imperceptibly, making a different bet. They are rotating out of gold and into silver, recognizing that the fundamental drivers of value have shifted, and that by 2026, silver will not just be a strong performer, but a strategic imperative, leaving gold in its wake. The hidden math behind this rotation is complex, but it boils down to a critical divergence in the fundamental utility and supply-demand dynamics of the two metals. Gold's primary value proposition remains its monetary role, a hedge against inflation, a safe haven, and a store of wealth. While these roles are still relevant, they are increasingly being challenged by new asset classes and a global economy that demands more than just passive storage. Silver, on the other hand, possesses a unique dual nature that makes it indispensable to the future. It is both a monetary metal, with a rich history as currency, and, crucially, an industrial metal, a critical component in the technologies that are shaping our modern world. This industrial demand is not just growing, it's exploding, driven by multi-trillion-dollar global initiatives that are structurally changing the demand profile for silver in a way that gold simply cannot match. Let's dissect the data that big investors are seeing. The global push towards renewable energy is perhaps the most significant driver. Solar panels, the cornerstone of this transition, are heavily reliant on silver due to its unparalleled electrical conductivity. As nations commit to aggressive decarbonization targets, the demand for solar installations is skyrocketing. The International Energy Agency, IEA, and various government reports project exponential growth in solar capacity over the next decade. Each new solar panel requires a precise amount of silver, and while efficiency gains might slightly reduce the silver content per unit, the sheer volume of new panels being deployed ensures a massive sustained increase in demand. This isn't a cyclical trend. It's a structural, multi-decade build-out that positions silver as an indispensable commodity. Then consider the electric vehicle, EV, revolution. Modern EVs are not just cars. They are sophisticated electronic devices, packed with sensors, advanced battery management systems, and complex wiring harnesses. Silver's superior conductivity and resistance to corrosion make it critical for numerous electrical contacts, switches, and connections within these vehicles. As the automotive industry rapidly electrifies, with major manufacturers committing to phasing out internal combustion engines, the production of EVs is scaling at an unprecedented rate. Millions of EVs are being produced annually, and each one represents a significant permanent consumption of silver. This demand is not speculative. It's a direct consequence of a global industrial transformation. Beyond solar and EVs, silver is critical to 5G technology, advanced medical devices, printed electronics, and a myriad of other high-growth sectors. The cumulative effect of these industrial demands is creating an unprecedented strain on global silver supply. And here's the crucial part that big investors understand. Unlike gold, which is largely held as bullion and jewelry and can be melted down and recycled, a significant portion of industrially consumed silver is effectively used up or becomes extremely difficult and uneconomical to recycle. The tiny amounts of silver in a solar panel or an EV circuit board are often not recovered, meaning that industrial demand represents a permanent depletion of the above-ground supply. This is a fundamental difference from gold, where virtually all historically mined gold is still in existence, either as jewelry, bullion, or in central bank vaults. Now let's look at the supply side, which is equally compelling for big investors. Global silver mining output has been stagnant or even declining in recent years. Silver is primarily mined as a byproduct of other metals like copper, lead, and zinc. This means that its supply is largely inelastic to its own price. Even if silver prices surge, miners won't necessarily increase silver production unless the primary metal they are targeting also becomes more profitable. Furthermore, high-grade silver deposits are becoming increasingly rare, and new discoveries are few and far between. The cost of extraction is rising, and environmental regulations are becoming stricter, making it harder and more expensive to bring new supply online. The data shows a consistent trend. Industrial demand is soaring, while mining supply is struggling to keep pace. This creates a widening structural deficit in the silver market, meaning more silver is being consumed than is being mined each year. This deficit is currently being met by drawing down existing above-ground stockpiles, but these stockpiles are finite and rapidly diminishing. The U.S. Geological Survey, USGS data, often overlooked by retail investors but closely watched by institutions, paints a stark picture. For years, the world has been consuming more silver than it produces from mines. This gap is filled by recycling and drawing down inventories. But these inventories, particularly those held in COMEX vaults, are at multi-decade lows. The amount of registered silver available for delivery has plummeted, signaling a tightening market that is far more severe than what is generally understood. This isn't just a temporary imbalance, it's a fundamental supply-demand squeeze that is accelerating. Big investors with their long-term horizons and deep analytical capabilities are seeing this structural deficit and positioning themselves accordingly. They are not waiting for the mainstream media to report on it. They are acting on the data now, quietly accumulating physical silver and silver-related assets. The gold-to-silver ratio, a historical indicator of their relative value, also screams that something is fundamentally mispriced. Historically, this ratio has hovered around 15, 1 or 20, 1, reflecting their relative abundance in the Earth's crust. Yet, for decades it has been much higher, often above 70, 1 or 80, 1, and at times even over 100, 1. This suggests that silver is significantly undervalued relative to gold, especially when considering its burgeoning industrial demand. The data proves that the market has not yet fully priced in silver's critical role in the new economy. As the world wakes up to the indispensable nature of silver for the green energy transition and technological advancement, this ratio is poised for a dramatic correction, pushing silver prices far higher than gold on a relative basis. Big investors are not just looking at the absolute price of silver. They are looking at this ratio, understanding the immense upside potential as it reverts to its historical mean, or even surpasses it, driven by silver's unique industrial utility. The year 2026 is the critical juncture because it's when many of these trends are projected to hit their stride. The build-out of solar infrastructure will be in full swing, EV production will be ramping up dramatically, and 5G will be widely deployed. Simultaneously, the effects of years of underinvestment in silver mining will become acutely apparent, leading to a severe supply crunch. This isn't a gradual shift. It's a sudden, violent repricing that will shock the world. The data, when analyzed without the bias of historical gold-centric thinking, points to an inevitable conclusion. Silver is not just a monetary metal. It is a strategic industrial commodity that is essential for the future, and its value will reflect that reality. The quiet rotation out of gold and into silver by big investors is a testament to this understanding. They are not waiting for the public to notice. They are positioning themselves now, before the script is fully flipped and before the opportunity becomes obvious to everyone else. This is how smart money operates, identifying structural shifts early and acting decisively, long before the masses catch on. The quiet rotation of capital from gold to silver by big investors isn't a fleeting trend. It's a calculated strategic move, deeply rooted in a sophisticated understanding of macroeconomics, technological imperatives, and the impending structural shifts that will redefine global commodity markets by 2026. As we dissect the intricate data points driving this monumental shift, comment "Smart Money Moves" below if you believe institutional investors are always one step ahead of the retail market. This isn't about mere speculation. It's about the cold, hard logic of capital allocation, where trillions of dollars are being repositioned based on an undeniable convergence of factors that are systematically eroding gold's traditional advantages while amplifying silver's indispensable role in the future economy. For decades, the investment thesis for gold has been straightforward: a hedge against inflation, a safe haven during geopolitical instability, and a store of value when fiat currencies are debased. This thesis, while historically valid, is increasingly being challenged by the evolving nature of global finance and technology. Gold's primary utility remains largely passive. It sits in vaults, it's worn as jewelry, or it's traded as a financial instrument. Its industrial demand, while present, is relatively minor compared to its total supply and is not growing at an exponential rate. This fundamental characteristic makes gold primarily a reactive asset, gaining value when other assets falter or when fear grips the market. Big investors, however, are looking for proactive assets, commodities that are not just defensive, but are also positioned for structural growth, driven by undeniable global trends. This is precisely where silver enters the picture, and why it's becoming the preferred choice for forward-thinking institutional capital. The core of this rotation lies in silver's unparalleled industrial utility, a factor that gold simply cannot match. We've touched upon solar panels and electric vehicles, but the scope of silver's industrial indispensability is far broader and deeper than most realize. Consider the burgeoning field of advanced electronics. Every smartphone, every laptop, every server in a data center, every smart device in the Internet of Things, IoT, contains silver. Its superior electrical and thermal conductivity, combined with its malleability and resistance to corrosion, make it irreplaceable in countless applications. As the world becomes increasingly digitized and interconnected, the demand for these electronic components will only accelerate. The rollout of 5G and soon 6G networks, for instance, requires massive amounts of new infrastructure, from base stations to antennas, all of which utilize silver in their critical components. This isn't a niche market. It's the very foundation of the modern digital economy. Furthermore, silver's role in medical technology is expanding rapidly. Its antimicrobial properties make it invaluable in everything from surgical instruments and wound dressings to advanced imaging equipment. As global healthcare demands increase and medical technology advances, so too will the demand for silver in this critical sector. Water purification systems, another essential and growing global need, also rely on silver's unique properties. Even in traditional manufacturing, silver is used in brazing alloys, bearings, and catalysts. The sheer breadth and depth of silver's industrial applications mean that its demand is not tied to a single sector, but is diversified across multiple high-growth industries that are fundamental to global progress. This diversification of industrial demand provides a robust and resilient floor for silver's value, a characteristic that gold, with its more concentrated demand profile, simply does not possess. Now, let's revisit the supply side, which is the other half of the equation driving big investors' rotation. The data unequivocally shows a persistent and widening structural deficit in the silver market. Global mine production has been stagnant or declining for years, a trend exacerbated by underinvestment in new exploration and the increasing difficulty of finding high-grade deposits. As previously noted, approximately 70% of silver is mined as a byproduct of other metals. This means that even if silver prices were to skyrocket, primary silver production cannot simply be ramped up independently. The supply is largely inelastic to its own price, making it incredibly vulnerable to demand shocks. Big investors understand that this inelasticity, combined with surging industrial demand, creates an explosive scenario. The dwindling above-ground stockpiles are the clearest indicator of this impending crisis. COMEX registered silver inventories, which represent the readily available supply for industrial users and investors, have plummeted to multi-decade lows. This isn't just a theoretical number, it's a physical reality. When these inventories are depleted, the market will be forced to confront a severe physical shortage. Industrial users, who cannot simply switch to an alternative metal due to silver's unique properties, will be forced to bid up prices dramatically to secure their supply. This is the before you even notice part of the title. While retail investors might be focused on daily price fluctuations, big investors are watching these inventory levels, understanding that the physical market is tightening to an extreme degree, signaling an inevitable price explosion. The year 2026 is projected to be the point where these stockpiles reach critically low levels, making the supply deficit undeniable and forcing a market reckoning that will be swift and brutal for those caught unprepared. The gold-to-silver ratio, a metric closely watched by sophisticated investors, further validates this rotation. The historical average ratio, reflecting their relative abundance in the Earth's crust, is around 15:1. Yet for decades, this ratio has been artificially inflated, often hovering above 71 or 80:1. This extreme divergence indicates a profound undervaluation of silver relative to gold, especially when considering silver's burgeoning industrial demand. Big investors are not just looking at the absolute price of silver, they are looking at this ratio, understanding that a reversion to its historical mean, or even lower, implies a massive upside potential for silver. A return to a 41 ratio, let alone 21, would mean silver's price would have to increase dramatically relative to gold. This isn't a speculative bet, it's a statistical arbitrage opportunity based on historical data and fundamental drivers. The rotation out of gold and into silver is, in part, a bet on the inevitable compression of this ratio, a bet that the market will eventually correct this historical anomaly. Beyond the fundamental supply-demand dynamics, big investors are also considering the broader macroeconomic and geopolitical landscape. The unprecedented levels of global debt, the persistent inflationary pressures, and the increasing fragility of the fiat monetary system are all factors that drive demand for hard assets. While gold has traditionally been the primary beneficiary of these concerns, silver offers a more accessible entry point for a wider range of investors, and its industrial utility provides an additional layer of demand that gold lacks. Furthermore, the geopolitical competition for critical resources, particularly those essential for the green energy transition, adds another layer of strategic importance to silver. Nations and corporations are increasingly recognizing silver as a strategic metal, essential for national security and economic competitiveness. This recognition will further fuel demand and potentially lead to resource nationalism, export restrictions, and other measures that will tighten supply and drive up prices. The before you even notice aspect of this rotation is crucial. Big investors operate with a long-term perspective, often accumulating positions quietly over extended periods, well before the retail market becomes aware of the underlying trends. They have access to proprietary research, advanced analytics, and direct relationships with producers and consumers, giving them an informational edge. By the time the mainstream financial media starts reporting on silver's surge, or when the gold-to-silver ratio has already compressed significantly, much of the initial upside will have already been captured by these early movers. This is how wealth is transferred in financial markets, from the reactive to the proactive, from the uninformed to the informed. The data is already there, signaling this shift, but it requires a deeper dive than most retail investors are willing or able to undertake. The year 2026 is not an arbitrary deadline. It's the projected point where these converging forces will reach critical mass. The cumulative effect of years of structural deficits, dwindling stockpiles, and surging industrial demand will become undeniable. The market will be forced to reprice silver to reflect its true value as an indispensable industrial commodity and a critical monetary metal for the future. Big investors are not waiting for this moment. They are positioning themselves now, quietly rotating capital, understanding that the script is about to be flipped and that silver, not gold, will be the precious metal that truly shocks the world. This isn't just about making money. It's about understanding the fundamental shifts in the global economy and positioning yourself on the right side of history. The quiet rotation of capital from gold to silver by big investors is not merely a financial maneuver. It is a profound reevaluation of value, a strategic repositioning that will culminate in 2026, fundamentally altering the landscape of wealth and leaving those who fail to adapt on the wrong side of an unprecedented economic shift. As we unveil the ultimate implications of this monumental rotation, comment "future-proof" below. If you are actively adjusting your portfolio to align with the insights of smart money, this isn't a speculative prediction. It's a meticulously analyzed trajectory based on undeniable data, industrial imperatives, and the strategic foresight of the world's most sophisticated investors, all pointing to silver's ascendance as the indispensable metal of the 21st century. The traditional narrative surrounding precious metals has long been dominated by gold, hailed as the ultimate safe haven and a timeless store of value. This narrative, while deeply ingrained, is increasingly becoming a relic of a bygone era. The world is undergoing a rapid transformation, driven by technological innovation, the urgent need for sustainable energy solutions, and a global economy grappling with unprecedented levels of debt and inflation. In this new paradigm, gold's primary role as a passive store of value, while still relevant, is being overshadowed by silver's active, indispensable utility. Big investors, with their access to proprietary research and long-term strategic vision, are not merely observing these changes. They are actively positioning their vast capital to capitalize on them, quietly rotating out of gold and into silver, long before the retail market even begins to notice the full extent of this shift. The core reason for this strategic rotation lies in the fundamental difference in the demand profiles of gold and silver. Gold's demand is largely driven by jewelry, central bank reserves, and investment, making it highly susceptible to shifts in sentiment, geopolitical events, and monetary policy. While these factors can drive gold prices higher, they do not provide the same robust, structural demand floor that silver enjoys. Silver, on the other hand, is an industrial powerhouse, a critical component in the very technologies that are shaping our future. The green energy revolution, with its insatiable demand for solar panels and electric vehicles, is creating a demand pull for silver that is unprecedented in history. Each solar panel, each EV, represents a permanent consumption of silver, a metal that is often unrecoverable or uneconomical to recycle from these applications. This consumptive industrial demand creates a constant, growing drain on global silver supply, a dynamic that gold simply does not share. Consider the sheer scale of the green energy transition. Governments worldwide are committing trillions of dollars to decarbonization efforts, pushing for massive deployments of solar and wind power, and accelerating the transition to electric transportation. These are not temporary stimulus packages. These are multi-decade structural investments that will fundamentally reshape global energy infrastructure. Silver is at the heart of this transformation. The data from organizations like the International Energy Agency, IEA, and various industry reports consistently project exponential growth in solar capacity and EV production over the next decade. This translates directly into a proportional and often exponential increase in silver demand. Big investors are not just looking at the current demand. They are projecting this future demand, understanding that the supply-demand imbalance for silver is set to become critically severe. Furthermore, the supply side of the equation is equally compelling for these sophisticated investors. Global silver mine production has been stagnant or declining for years, a trend exacerbated by underinvestment in new exploration and the increasing difficulty of finding high-grade deposits. The fact that most silver is a byproduct of other metal mining means its supply is largely inelastic to its own price. Even if silver prices surge, primary silver production cannot simply be ramped up independently. This inelasticity, combined with surging industrial demand, creates an explosive scenario. The dwindling above-ground stockpiles, particularly those held in COMEX-registered warehouses, are the clearest indicator of this impending crisis. These inventories, which represent the readily available supply for industrial users and investors, have plummeted to multi-decade lows. This isn't just a theoretical number. It's a physical reality that signals an extreme tightening of the physical market. Big investors, with their long-term horizons and deep analytical capabilities, are seeing this structural deficit and positioning themselves accordingly, understanding that the physical market is tightening to an extreme degree, signaling an inevitable price explosion. The gold-to-silver ratio, a metric closely watched by sophisticated investors, further validates this rotation. The historical average ratio, reflecting their relative abundance in the Earth's crust, is around 15:1. Yet, for decades, this ratio has been artificially inflated, often hovering above 70:1 or 80:1. This extreme divergence indicates a profound undervaluation of silver relative to gold, especially when considering silver's burgeoning industrial demand. Big investors are not just looking at the absolute price of silver. They are looking at this ratio, understanding that a reversion to its historical mean, or even lower, implies a massive upside potential for silver. This isn't a speculative bet. It's a statistical arbitrage opportunity based on historical data and fundamental drivers. The rotation out of gold and into silver is, in part, a bet on the inevitable compression of this ratio, a bet that the market will eventually correct this historical anomaly. The before you even notice aspect of this rotation is crucial. Big investors operate with a long-term perspective, often accumulating positions quietly over extended periods, well before the retail market becomes aware of the underlying trends. They have access to proprietary research, advanced analytics, and direct relationships with producers and consumers, giving them an informational edge. By the time the mainstream financial media starts reporting on silver's surge, or when the gold-to-silver ratio has already compressed significantly, much of the initial upside will have already been captured by these early movers. This is how wealth is transferred in financial markets, from the reactive to the proactive, from the uninformed to the informed. The data is already there, signaling this shift, but it requires a deeper dive than most retail investors are willing or able to undertake. The year 2026 is not an arbitrary deadline. It's the projected point where these converging forces will reach critical mass. The cumulative effect of years of structural deficits, dwindling stockpiles, and surging industrial demand will become undeniable. The market will be forced to reprice silver to reflect its true value as an indispensable industrial commodity and a critical monetary metal for the future. Big investors are not waiting for this moment. They are positioning themselves now, quietly rotating capital, understanding that the script is about to be flipped, and that silver, not gold, will be the precious metal that truly shocks the world. This isn't just about making money. It's about understanding the fundamental shifts in the global economy and positioning yourself on the right side of history. The emotional impact of this shift cannot be overstated. For generations, gold has been the symbol of wealth and stability. To see it quietly, yet definitively, overtaken by silver will be a psychological shock to the financial world. It will force a reevaluation of deeply held beliefs and challenge the very foundations of traditional investment wisdom. Those who embrace this new reality, who act on the data rather than on outdated dogma, will be positioned to thrive. Those who cling to the past, who dismiss silver as a secondary metal, will witness a monumental transfer of wealth, a quiet redistribution from the uninformed to the informed. This isn't a matter of opinion, it's a matter of mathematics, industrial necessity, and the relentless march of progress. The data proves it. The trends are undeniable, and 2026 is the year the world wakes up to the quiet power of silver. Don't be left behind. The time for action is now.